Vanguard compared the historical performance of dollar cost averaging, or DCA, with lump sum investing, or LSI, across three markets: the United States, the United Kingdom, and Australia. And on average, they found that lump sum investing outperformed dollar cost averaging approximately 2/3 of the time, even when the results were adjusted for the higher volatility of a stock bond portfolio versus cash investments.
Welcome to the Military Money Manual podcast, where every episode is all about achieving financial independence in the military faster than before. We believe personal finance shouldn't be boring or intimidating. Building wealth can be simple, and financial freedom is the ultimate financial goal. Now, here's your hosts, Spencer and Jamie.
Today in the show, we're talking about lump sum investing versus dollar cost averaging. First of all, we're going to talk about what does each word mean. We'll talk about some of the benefits of lump sum investing, and we'll talk about some of the benefits of dollar cost averaging. But Jamie, what are the three big takeaways we want listeners to have today?
First of all, it doesn't matter most of the time. The more important thing is to have a plan, whether it's a formal plan like an investment policy statement or an informal conversation with your partner or your spouse. Just keep buying throughout the good times and the bad. And number three, when there's a windfall, there is data supporting lump sum investing to be slightly better, but it's not going to be a big deal breaker as long as you keep investing no matter what.
Yeah, so let's define what we mean by each phrase, Jamie. So lump sum investing, we're talking about taking all your available capital. So let's say that you received a $20,000 bonus from the military for your AFSC or for your job, maybe a pilot bonus, and you're going to invest it immediately in your chosen allocation of stocks and bonds. So a lot of times people contribute their bonuses directly to the thrift savings plan, the TSP, and that would be a lump sum investing because you're putting it all in at one time. And then dollar cost averaging is systematically investing equal amounts over time. So taking the $20,000 bonus, and instead of investing it all at once on one day, you're going to invest $1,667 monthly over 12 months. Or if you had a $6,000 bonus, you can invest $1,000 over 6 months. And the idea there is the market will be up on some days, the market will be down on some days, but in general, the market moves up and to the right. And so you'll be able to purchase some shares on down days, and you'll be able to purchase some shares on higher days, and it'll all average out over the time period that you're buying.
And there is definitely a psychological factor here, because let's say you put $20,000 in the market and it drops the next day. Maybe it's down 3% in one day, and then it's down 20% in a couple months. Maybe it's COVID-19 again, and you don't know where the bottom of the market is or when it's ever going to recover. And that's definitely a valid concern, especially when we're talking about your hard-earned military pay. But like we mentioned already, the research tells us from the Vanguard studies and a couple others that over rolling 10-year periods across the three major markets, lump sum investing outperformed DCA 2/3 of the time. Like you said, the average performance is about 2.3%. So it's not insignificant, but it's not going to make you a multimillionaire if you weren't going to be already a multimillionaire.
Yeah, let's be clear there, Jamie. That's 2.3% on the final ending value. So it's not 2.3% annualized. It's not 2.3% compounding return. It's just a difference between whether you had $1 million at the end or $1,023,000 at the end. So it's 2.3% of the final value, which over a 10-year period, like, are you even going to know that or realize that? It's a hindsight thing. Like, you could know what the right answer was. Like, if in January 2020, you received the bonus, you invested all of it in January 2020, and then the COVID crash happened, you'd be like, dang it, I should have just waited a couple months. But it's just complete, like, making predictions is very hard, and it's even hard, making predictions about the future is even harder. So I think this is one of those things where you have to control what you can control, and what you can control is having a plan. For myself personally, I've written down an investment policy statement. And so what I have in there is, it says, if I receive money, this is how we invest it, and this is how we allocate it. And I can update that plan. I can discuss that plan with my spouse, but at least I have something written down that I can refer back to. And so that I'm not just making it up every time that I get another chunk of money.
Yeah, and the reason that we advocate for taking the emotions out of it and trying to time the market or wondering what it's going to do is that if you miss just the 10 best trading days between 2002 and 2022, just the 10 best trading days, it would cut your returns by 50% according to FINRA analysis. So you don't know, even the most experts of experts out there don't know what the market's going to do, but by just consistently and unemotionally putting it to work in accordance with your goals and in alignment with your values, you're going to hit the ups and the downs of the market, but just keep buying no matter what.
There's another Schwab study, Jamie. It's very similar to that FINRA study. And they've got this great chart out there. You can Google like the 10 best trading days Schwab, and it shows like how much your returns are reduced when you miss just, a couple good trading days in the market. And you don't know when those days are going to be. So right now, here we are in March 2025. We've had a couple down days in the US stock market. People are starting to get a little bit nervous. They might be thinking, ooh, maybe I moved some money out of the C fund into the G fund. No, you missed the boat. That ship has sailed. Do not performance chase. Do not make a move like that. There was another 2008 Schwab study of the 2008 financial crisis, and they found that even investors who invested lump sums at the market peak in 2007 broke even within 4 to 5 years if they stayed invested. So that's the key right there, is you have to stay invested. There's a great article on the website, wealthofcommonsense.com, called The World's Worst Market Timer. And it talks about someone who saves up all their money and then lump sums invests the market peak just before there's a huge crash. And guess what they found? Even in that situation, they still end up doing just fine, right? But the key point is they never sell. And that's what people have to realize, is that when you're investing for the long term, you can't be looking at your portfolio every day. You can't be thinking about, oh, I just lost $1,000, $10,000, $100,000 in the stock market. No, you didn't. The shares are still there. You still have the shares. You still have ownership of those companies, and you're still going to reap the benefit of the ownership. It's just there's been a temporarily adjustment to the value that people have assigned those companies, and that will be adjusted again in the future.
And like we've said many times before, in order to time it perfectly, you have to be right twice, and you have to time it perfectly 2 times to maximize it, which is almost impossible to do for the average military family or investor. So just know that we are average investors just like you. We ride the average curve, and we're happy to be in the middle. But now let's transition talking a little bit about compare and contrast between the two. Spencer, I'll start with some benefits of lump sum investing. We mentioned the statistics. You beat dollar cost averaging 69% of the time. That's not a made up stat. That's actually a study. Long-term investing is where it's at, and that's where your long-term focus. So it doesn't matter what the market does tomorrow, because you're looking at 20, 30, 40 years in the future. You can handle the short-term drops in the market, and it also eliminates some of the decision fatigue. It's one decision and it's done. You decide once to contribute in alignment with your values, and you don't have to worry about it.
Yeah, and then for dollar cost averaging, the psychological benefit is there where, let's say you're about to invest $10,000 and you put it all in March 2020, and within a couple of weeks, you see your $10,000 evaporate to $7,000 or $6,000, depending on the asset that you put it into. That can be difficult, but if you know that it's temporary and you understand that the repricing of stocks is a feature, it's not a bug. Like, this is how the market is supposed to work. It's supposed to be able to update the price daily, or every day there's a trading day. But like Warren Buffett says, Mr. Market is this insane person who's constantly just yelling at you what the current price of your shares are. And if you're a long-term investor, like, you don't really care. He gives this analogy of you're a farmer with a bunch of cows, right? And you're like, hey, I milk the cows, I sell the milk, and I make profit from that. And I don't need someone coming to me every single day and shouting at me for 9 hours a day. Hey, I'll pay you this much for your cows. Hey, I'll pay you this much for your farm. Hey, I'll pay you this much. You don't care. You're a farmer. You're just doing your thing. You don't need to listen to this crazy guy who's constantly shouting at you. And so that's what it's really important to just turn off the financial news media, unsubscribe from all those Instagram accounts other than Personal Finance Club and Military Money Manual, and just recognize that when you're a long-term investor, you can just tune all that out, because what the market does is it reassigns capital from the impatient to the patient. And if you're patient and you stay the course and you understand that you're investing with the LADS method, low cost, automated, diversified, and simple, and low cost index funds, you're going to do all right. And the TSP, the Thrift Savings Plan, is the perfect long-term investment for your retirement there.
Yeah, speaking of the TSP, Spencer, I want to talk about a couple caveats. So lump sum is basically not available in the TSP unless you get a big bonus from your MOS or your AFSC or continuation pay under the blended retirement system. You're effectively dollar cost averaging every month if you have an automatic contribution. And remember, you should probably be doing, almost everyone should be doing 5% minimum to get the match if you're under the blended retirement system, hopefully working up to more than 5%. Maybe it's 1% extra each year. Maybe you're trying to get to 10, 15, 25%, 40% if you're achieving are pointing towards financial independence, retire early, or FIRE. Also, this conversation, remember, it's not about short-term savings. It doesn't matter what your net worth does tomorrow. We're focused on what your net worth does 20, 30, 40, 50 years from now. So I don't care if it drops 2%. Like right now, as we're recording this in March of 2025, I hear that it's dropping, but I'm not looking at my net worth panicking because I'm confident that, how old am I? In 30-ish years from now when I need the money, 20-ish years from now when I need the money, it's going to be up and to the right and I'll be okay. Also, another conversation, Spencer, I'll kick this one over to you. What about your Roth IRA? Sometimes we hear of people saving up $7,000 and then on January 1st in 2025 limits, they might lump sum $7,000 into their Roth IRA on day one of the year. Any thoughts on that?
Yeah, I mean, that's a great example of lump sum investing versus dollar cost averaging. And the earlier you get your money to work, usually the better off it's going to be. If you look at the long-term history of the US stock market, the earlier you can get your money invested, the faster and the more it can grow. And so it doesn't make sense if you think about it, right? Like, when would you rather have invested in 1950 or 1960? It's like, well, I don't care. Like, not even knowing what the value of the stock market was, I know I want to be invested in 1950 because the earlier you get your money to work, the more it's gonna be working for you. So yeah, I see this a lot online where people will set aside money throughout the year, or maybe they take a little bit out of their emergency fund, put it into their Roth IRA because they know that they can withdraw the contribution at any time. And then they start saving again for the next year's contribution. Also, make sure it's important when you put money into your Roth IRA that you're investing it and you're not just letting it sit in cash. If you want to contribute every week or every time you get paid on the 1st and the 15th or every month, whatever schedule you want, just get your money to work as fast as possible for you. It doesn't do any good just sitting there in cash.
And you can still automate it even when you're dollar cost averaging and set that up automatically. I'm going to pull out my Billy Club and beat a dead horse here and just really make sure that the listener understands why we're confident that the stock market is going up. It's because, like Spencer said, we're doing the index funds. We're buying some of every country, or maybe we're buying some of the top 500 countries in the American economy. I'm not going out there looking for GE or Spirit Airlines. Like, I don't know what Spirit Airlines stock is going to do. Right now, I'm pretty confident it's not going to do good. But when I buy a little bit of every company, it gives us the confidence in the entire economy of the Western world and really of all of civilization. We're not trying to pick the winner. We're just riding the average index funds. And that's why, based on the historical trends, we're confident that it's going to continue to do that. So what can you do with this information today? If you have a lump sum amount ready to go and you have a stronger risk tolerance, consider going all in. But if you're nervous about it and you're unsure about the market timing or it's down right now, just dollar cost average it over maybe 3, 6, 12 months, whatever. And if you're unsure, you can always split the difference. You can invest 50% of it right now and get some lump sum in, and then dollar cost average the rest of it. The most important thing, like we said earlier, is that you invest with a plan and you keep investing and don't let the nerves of the news media cycle and things like that affect your long-term strategy.
Yeah, don't let analysis paralysis impact your future net worth. So once again, Jamie, most of the time it doesn't matter. Lump sum investing, dollar cost averaging, this is really splitting investing hairs. The most important thing is your savings rate. Let's get back to first principles here. Whether it's lump sum investing or dollar cost averaging, you're going to be fine. If you want to put the money to work right now, great. If you're a little bit nervous and you're not sure what you're doing, okay, put a little bit in. But the important thing is to have a plan, have an asset allocation. And even if that's as simple as just mirroring what your life cycle fund is in the thrift savings plan, great, just do that. But have something written down, or at least have a verbal confirmation contract with yourself. And then there are some studies supporting, if you get a windfall payment, that lump sum investing does beat dollar cost averaging in the long run. But again, it's a very small margin and it'll probably all come out in the noise of the market cycle anyways. So there's some information for you on lump sum investing versus dollar cost averaging. Hope that was helpful. Leave us a 5-star review.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.